Good morning. This is Fred Whitaker, and I'm with Cummins White, and we're going to talk about tax and succession planning today for the California independent oil marketers. Really, the themes about today are all going to be about how we get to a proper succession plan, and I think there's two things that you really have to think about: structure and successors. Who are your successors, and what kind of structures do we want to be able to undertake the best type of succession planning for the future? So let's talk about 2018 and where we are in the current tax status of different organizations. You need to be able to protect your current profits. You have to be able to seize the day, because if we can't protect current profits now, succession planning later isn't going to have a good valuation. Tax reform, which just passed, provides amazing opportunities, but it also makes a lot of your planning and your structuring much more complex. I would encourage all of you to come to the SIOMA Day in the Capitol in April, because I'm going to be presenting an entire presentation just on the Tax Reform Act, the Tax Cuts and Jobs Act of last year, which is called H.R. 1. The primary thing that H.R. 1 did was that it took ordinary income rates on the federal level down from 39.5% to 37.5%. But what it didn't touch is it didn't touch capital gains and dividend rates. They're still at 20%, and amazingly, the 3.8% Affordable Care Act surtax is still in effect. So for almost all circumstances, when you sell a company or you take dividends out, you're still going to have a 23.8% tax. And that was one of the things people really thought was going to get eliminated or lowered, but it didn't. And of course, nothing has changed about California's top marginal rates. They're at 13.3%, which really will affect most of the owners in this industry. Another thing is that there's no deduction for state taxes in excess of $10,000. And of course, most everyone in this industry is paying taxes in excess of $10,000. So in that new environment, how do we take advantage in our structuring of the current tax status? Well, we're not going to be able to move out of state because we have operations here. But what can we do? So there are three different structures or structuring items that we're going to talk about today. One's a defined benefit plan, two is captive insurance, and three is equipment expensing. And these are all great tools for both short and long term. What's the short term? The short term is making sure that you keep more of your cash flow, more of your profits today, and building your assets. And the long term, which allows you a lot more flexibility for the long term, is making sure that those assets will produce value as you work towards a succession plan. In 2018, on the corporate side, our rates were reduced from 35% to 21% on the federal level. And that's an amazing savings, and that's what's going to drive a lot of some of these structuring changes. For S-Corps and partnerships, they also get a deduction of 20% of qualified business income, or what they call QBI. And in a shorthand way, this really effectively reduces the pass-through rate on income coming out of those organizations to 29.6%. So what's the planning opportunity? The planning opportunity is that if you look at what your companies do, and almost all of your companies have multiple entities, some, it might be wise for us to make them a C Corp if they were an S Corp and build up cash at a 21% federal rate. Realize California's corporate rate doesn't have that 13.3 on the individual, it's only 9. And so this could help a lot with succession planning if we go to sell something later. And we'll talk about that with the Internal Revenue Code Section 1202 type transaction. The next thing we want to talk about is, so we kind of gave you a preview of structuring, but what's the reason we need succession planning? Well, we're in a turbulent time. In the past, almost everyone in this industry grew the company and then gave it to the kids. Many companies in SIOMA are second and third generation businesses. But now circumstances are different. We have lots of businesses where we're not going to make it to the fourth generation, or maybe not even the third, partly because there's huge price volatility that really creates a crunch on capital. There's decreasing volumes. Did you know that in this business, volumes on average have gone down 30% since the recession started, really at the end of 2008? And because of that, we actually have, in the petroleum industry, somewhat of a fearful economy. At retail, we've had high margins and great valuations for the last couple of years, but can that go on forever? Those shrinking supplies and increased prices have increased borrowing. On the wholesale side, there's been, as we've had low prices, there's been shrinking margins, increased regulations in California, increasing pace of business. And this is the number one reason that many of the businesses aren't going to make it to the next generation, is that families increasingly independent. They have different things that they want to do. So if it's not automatically going to go to the kids, what are some of the structures that we can talk about and look at, something that would help us from an income tax perspective today, but also prepare us for options going forward? One of the things that I like to talk about a lot with my clients is a leasing company and a defined benefit plan. And so the concept here is that in your operating company, your profits, depending on your tax rates, can be taxed at upwards of 50%, maybe even a little higher. So what if we created a leasing company owned by the adult children who may or may not want to be in the business, but might want to have income someday, to own either the real estate for the business or own the equipment? Every one of those payments into a leasing company is going to be tax deductible. So if you look at the bottom of the graph on the left, we take tax deductible payments for leasing out of the operating company, and you put it into the leasing company, and that's our middle part of the graph. And that leasing company receives income, but what does it do? It hires the operators, the owners of our operating company. That's mom and dad, perhaps generation two, whoever is the senior generation in the business today, the one that's looking at this potential need for succession planning. And it hires them as the only employees of the leasing company. Now, why is it important that we have adult children or people who aren't the primary owners? Well, for this to work, to have a separate retirement plan for the owners of the business they're employed in can't be owned by the same people that own the operating business. Otherwise, you have to provide the same retirement plan for all the employees. So if we have the adult children owning the leasing company, but they're employing their parents who are actually the owners of the operating company, and those are the only employees, we're actually then going to be able to establish a defined benefit plan. We pay their salary in the leasing company, and then we pay tax-deductible contributions into a defined benefit plan. And as you've noticed at the top of the graph, the money comes back out of the leasing company and goes into a defined benefit plan for the owners. And look at that. We can set aside, in addition to their salaries, upwards of $220,000 for each of the employees, say mom and dad, in a defined benefit plan. And that's growing tax deferred until distributions are required at age 70 and a half. That is a fabulous amount of money that we can set aside for mom and dad. And that's really important, one, because it's helping us reduce our tax burden currently, but allows us a lot more flexibility later on to take perhaps a lower purchase price or a structured purchase price, because much of the money that's needed for the retirement for Generation 2 has now been stuffed into a defined benefit retirement plan. Realize if they were only able to be in their company's 401k, at the maximum, they could have put away about $24,000 a year. Here, we're going to be able to put away $220,000 a year. So we're getting a current tax benefit. We're putting money away for the future that allows us more flexibility in the future. Another structure that I like people to look at for succession planning is called a Section 831B captive insurance company. So we're going to have pretty much the same type of graph. if you think about it, in your operating company on the left, you're going to have profits, depending on your tax rate and how it flows through, upwards of over 50% of your profits taxed. But every single one of these companies has risks that right now they are self-insuring. And what do you think about that? So smallest risk would be a deductible of $50,000 or $100,000 in your own plan, or there's other risks, overspill and overfill in excess of the insurance premiums. Risks such as earthquake, commercial earthquake insurance is very hard to get. Sometimes there's kidnapping risk. Sometimes there's risk of fuel contamination that's over and above what the insurance would pay. Lots of different risks that the business takes every day. A large one in the petroleum industry is accounts receivable risk. Now, there are products in the open market to buy for accounts receivable, but sometimes they can be expensive. And if you've got a fairly good history of collecting your accounts receivable, we could go to an actuary and determine what a premium would be that would be reasonable, but something that puts money aside. You take those tax-deductible premiums on whatever we think those risks are that are true to your business, and an actuary can say, that's a risk I can sign a premium to. And we send some tax-free premium over to the small captive insurance company. And just last year, the rules changed where the captive insurance company can take up to $2.2 million of premium without paying any income tax on it. And this is kind of an amazing thing, because when you think about it, if I took a tax deduction in the operating company, I'm going to have some sort of offsetting deduction in the insurance company, because if I don't, otherwise I've moved $2 million of taxable income over there. Well, I don't even have to have the deduction. Unlike the defined benefit plan example we showed before, where I'm using salaries and the contribution to the defined benefit plan to soak up the income. Here, the government just says you don't have to pay taxes on it at all. You just go invest it to make sure that you have reserves in case any of those claims come through. But we know those are risks that we normally self-insure. We know that normally we don't have claims. So as we're piling up $2.2 million a year, tax deductible out of our company and into our small captive insurance company that we also own, the only thing we're going to be paying taxes on are the investment earnings. In 4 to 7 years, if you look at the graph on the far right, what's going to happen? In 4 to 7 years, you likely had no claims. And that same actuary who's been setting aside the premiums and calculating the premiums is going to go to the Department of Insurance and say they need to either return premium to their insured or they need to issue dividends because they are over-reserved. Now, we don't want to return premium to the operating company, because if we did that, we'd actually just be sending taxable income back to the operating company. No, instead, we're going to issue distributions. Well, we know that distributions are taxed at 23.8% federal, a little over 13% on the state, and it's going to come out at 37 and a little tag over 37%. Well, think about it this way. If I had 50% taxable money back in year one, and I build it up and I take it out in year 5, after growing it, and I'm only paying 37%, that's a huge win. And then the other great thing is that we can have, and I'll show this later, a 678 trust actually be the owner of the captive. And a 678 trust, I'll show you later, is a trust that's there for the benefit of Generation 2, but ultimately goes to Generation 3. It's outside their estate. So whereas the operating company is inside the estate of the generation that owns and operates it, we can have the captive insurance company not only helping you from a perspective of current income taxation and a perspective of putting assets aside, so maybe you don't need to sell your company for as much, but also from that point of view of estate tax, reducing the estate tax burden on your kids. The other structure that I want to encourage people to look at this year is what's happened in tax reform with Section 179 and bonus depreciation. It is simply amazing. H.R. 1 modified the expensing limitation, increasing it from $500,000 to $1 million and $2 million in overall small purchasing to 2.5. So what does that mean? That means if you're a small business of qualified property, upwards of $2.5 million in your purchasing, you could write off $1 million 100% this year. For those of us in the petroleum industry, that's really critical because there are things that are qualified property in terms of your canopy, parts of your convenience stores that used to be on 15-year depreciation or some on even 39, now can actually be written off all in 1 year, up to $1 million. So why is that important for succession planning? It's important because if I improve the nature of my asset base with new equipment, things that are going to produce more revenue, and yet I can do it in a tax-efficient manner now, it only improves your value and helps you keep your money currently. So 2017 was the last year of 50% bonus depreciation, and everybody was concerned that it was going away. But H.R. 1 amazingly took it from 50%, where it was going to go down over the next couple of years down to 0, and took it to 100%. And also, it means that you don't have to actually use new property. Bonus depreciation usually used to be saved for just buying something new. 179 was something that was old and qualified, or new and qualified. Bonus depreciation was just for things that are new. So bonus depreciation now applies to almost every aspect of property that you're placing in service other than real estate or building improvements. That's where H.R. 1 and the 179 deduction can help you a little bit, is on some of our building improvements. But, you know, for the next several years, we're going to have 100% bonus depreciation, and then it's going to phase down in 20% increments. The best thing is that if I buy a used forklift, I still get to use 100% bonus depreciation. So what does that mean? I mean, there's not a lot of difference between the two, but what it means is that if you started putting something in service in this year, 2018, actually on the 100% bonus depreciation goes all the way back to the end of 17, we're going to be able to take 100% write-off. So even though you've lost the $10,000, the state income tax deduction only up to about $10,000, even though some of the other provisions in tax reform might not have been as robust as we would have liked, to have gotten rid of the Medicare surtax, this is an amazing tool. So let's just say you didn't want to use the defined benefit plan, or you didn't want to use the captive, or you didn't think you could put enough away. You can also use equipment expensing as a way to tax efficiently build your asset base. Now, this is asset base that's being built inside the business, maybe not as great for estate planning. But remember, if you're going to have a business that's going to have succession, you need to have a good working asset base. The whole idea behind H.R. 1 and tax reform, and especially these modifications to Section 179 and bonus depreciation, was to encourage people to invest in their businesses. I think it's just a remarkable tool that we have. You never know when power is going to shift in Washington, and before it does, while we still have this, I really encourage people to really look at what their capital spending needs are and potentially use it. So now that we talked a little bit about what type of structures you could use currently to help your current income tax position, and also prepare your structure for the future and allow you flexibility, let's talk a little bit about what's your succession going to look like. Why do you have to have a strategy? Well, you know, Kenny Rogers was the gambler. You got to know when to hold them, know when to fold them, know when to walk away, and know when to run. Things change, but everybody eventually at some point is going to leave their business one way or another. I really encourage people to think of their business like a private equity firm would. Your business is an investment. Venture capital should be the discipline for your business. What is the exit that's going to happen? If you take a look at even Peter O'Malley, he sold the Dodgers, and George Lucas, he sold Lucasfilm, because at some point, the price is right under the circumstances that are there for your family. And like I said earlier, everyone leaves their business, whether it's death, disability, retirement, or heaven forbid, a forced sale because we didn't manage things well. So how do you know if you're ready for the exit, or when to identify the right time for an exit? Well, how's the stress managing for you? Do you need a change? Is the risk of the business exceeding your comfort level? What are the paces, demands? Are they exceeding your capabilities in this ever-changing internet world in which we live? Retirement, death, disability, or hopefully just an offer you can't refuse. If you look at all 5 of those categories, they have something in common. If you're too stressed out to run the business, there's 2 options. You either sell it to somebody or let somebody else run it. If your risk is exceeding the comfort level, well, then you best sell it, because even if you let somebody else run it, it would still be your capital. If the pace is demanding, the pace and demands are exceeding your capabilities, you have to either sell it or let other people run it. In retirement, death, or disability, it's also selling it or letting other people run it. If it's an offer you can't refuse, it's just selling it. But what's the commonality of all of those? Well, if it's sale of business and others run it, conditions in the marketplace provide the right price and don't require you to be there. Commonality is that for a succession plan to work, the operating business needs to have an operator to have value. And this is something that we're going to talk about in the next slide in real detail. But I see it as the largest mistake in entrepreneurial businesses in this industry and others, is that the founder or generation 2 that have run it their whole lives don't have a good methodology for having somebody else come in behind them. And while it's producing a great lifestyle, it's not going to produce value going forward because there's nobody else to run it beyond them. And it really limits the options you have if you don't have a successor. The other thing is, you always have to have a readiness. I've seen so many entrepreneurs without a readiness, without an open mind, and without a real understanding of the value of their business. So if we're going to create opportunities, it's going to be where luck is meeting planning. And sometimes you have to create your own opportunity, and that's part of what we were talking about with the structuring for your defined benefit plan or your captive, so that we're putting away money regardless of what the economic circumstances are later. So you might have to create your own opportunity. So in succession planning, we talked about needing an operator, and it's really a question of who's it going to be. I like to think of it, there's 3 categories that you really have, or qualities you have to have in a person to be a good successor. There's the personal qualities, the financial qualities, and the managerial qualities. And if you think about it, the owner of the business today, the operator of the business today, probably has almost all 9 of these qualities. They've got a passion for it, they've got relationships in the industry and in the company, and they've got a lot of loyalty to the family legacy, loyalty to their employees, and loyalty to the industry. Almost every owner of these businesses today has got a good net worth. I don't know if you ever read the book, The Millionaire Next Door. There was also a sequel to it called The Millionaire Next Mine. And they had a couple of categories. One was a UAW and one was an OAW. And what does that mean? Well, a UAW is an underachiever of wealth, and an OAW is an overachiever of wealth. So if you think about the owners of these businesses who founded them, most of them are OAWs. They're overachievers of wealth. They figured out on a business that makes its money on the fraction of pennies how to make really good livings on those fraction of pennies by just marginally increasing income, marginally decreasing expenses, and saving money everywhere they could. You don't see a tremendous amount of flashy, extravagant spending in this industry, or in a lot of mainline entrepreneurial businesses, because the owners are overachievers of wealth. And so what I'm going to argue, and as we'll go through it, is you need to look for some of that same quality in your employee who's going to be a successor. Liquidity and cash flow. If you're an owner of the business, you've got it. Is your successor going to have it? Need for a legacy for their family. Managerial. Most of our owners have great capabilities. They have a great desire, and they have a great work ethic. So if you look at those 9 characteristics, we're going to want to try and see if somebody inside the business or somebody outside the business that you bring in has got at least maybe 6 to 7 out of those 9 characteristics. I truly think that the most important ones, if you just look per category, I think that passion and relationships are the most important on the personal side. You have to have somebody who's got a hunger to be in leadership and take on the position, and somebody who's not an introvert, somebody who doesn't sit in their office all day, somebody who's willing to be on the ground and walking around management with employees and willing to be in the industry, being at trade shows and other things that the current owner of the business does. Even if they're not an owner, they have to be willing to do that. And the financial side, I really think the thing that's most important when you're looking at for a successor is somebody who, if you're looking at their personal life as an overachiever of wealth and has enough liquidity or cash flow that they could participate in the business to some degree. And even if it's a small degree, that they could participate in to some degree, because you need somebody who can think and act like an owner. On the managerial side, you basically, I think the 2 main categories there are work ethic and their capability. Some people can be great salesmen. Some people can be great sales managers. It's often a mistake that companies in all industries make, where they will promote the greatest salesman to sales manager and then wonder why sales results fall apart. Because the person who had great skills at selling didn't mean they had great skills at managing or mentoring or teaching. So I think capability for management is really important. And work ethic. Nothing beats work ethic. Work ethic can overcome all sorts of skill sets that are lacking or skill sets that need improving. Because you work at it, you get better at it. So my encouragement to you is that in your businesses, we should be looking at not only the structures that we've been talking about earlier for current income tax planning that might give you future benefit, but also look as to who we can promote or who can we hire to make sure that we have a good operator in the business. So now that we have potentially a readiness for exit, we have to kind of discern the opportunities as they arise. We have to think out the box. An exit might not initially look like an exit. And what I'll encourage everybody to think about is that function is a lot more important than the form. Not everything is a sale. And so when we talked about having a good defined benefit plan set up for the owners, or we talked about having a good captive insurance company set up, part of that is so that we had a pot of money put aside for those owners, because some of these sales or transitions might not look like a sale. We might have actually been helping ourselves buy the owners out earlier. Valuation, you really need to know the market value of your business. So I encourage people to internally value their business like a competitor would value it if they were buying it. One of the things that I see is unfortunate is that owners often have an unrealistic view of the value of their business. It's provided a great living for their family for a long time, and so they have unrealistic values. There are people who have gone around who are valuation companies. The most notorious was Geneva and Equico, and they would go around selling appraisals that were pie in the sky. And owners would think that their businesses were worth 10 times what they really were worth. And it actually created a false set of expectations, and then it doesn't prepare an owner realistically for when the exit. So I want people to, if they've got the great operator and we've got some other structures in place, I want them to erase their expectations of a payout, because there's a lot of different ways to get to the same place. One of the things that I want you to think about is the small business stock exclusion. Now, if you remember, we talked about how C corporations now are going to be taxed in current income at only 21% from a federal level. Now, a lot of people don't want to be in a C corp because, oh, it's double taxation to get it out. But what if you didn't need that cash for a while? What if you didn't need it until you were going to sell the company? If we just took one or two of our entities that we didn't need the cash out of, and we converted them to a C corp, or we created a new division as a C corp, not only would you get only the 21% federal rate while it's making money, but look at what Section 1202 does. If I sell the stock of a small corporation and I created that stock after 2010 and I held it for 5 years and I sell it to somebody else, I pay 0 federal income tax on the sale of that stock. So you could even lower your purchase price from what you think the value is, give a few indemnities, and get a stock purchase that actually nets you more income and gets you out of liability over the long haul. It's an amazing tool, and the government has really just encouraged us to use this long-term planning tool more, because they just reduced the current income tax rates to 21%, allowing us to build up the income inside a C corporation at a low rate. And then if you hold it 5 years and sell it, you have the chance of having a 0% income tax rate. So let's go through just kind of a couple of examples. If we sold our company for $10 million, so one or two of your divisions you created, and you made them a C corporation, and we sell them under Section 1202, if it was only an asset sale, the ordinary income tax and recapture would apply to everything, and then capital gains would be of the shareholders. In an asset sale, I'd have $10 million sale. I'd have about 44% combined state and federal rate inside the corporation for about $4.4 million in tax. I then distribute out to the shareholders about $5.6 million in tax. Capital gains tax rates at the 23.8% plus our state rate would be about 37% blended for another $2.1 million in tax. And by the end of the day, what does the shareholder get out of an asset sale? Maybe $3.5 million net. That's horrible. But if I'm selling the stock of the company for under $10 million under Section 1202, I can have all of the sale or part of the sale, but we're looking for all of the sale, excluded. So I could offer to sell the stock for as low as $7.5 million and actually have $4 million more in cash than if I actually sold the assets for $10 million. That is a tremendous tool to use. That's where I'm looking at not thinking just I've got to sell the asset for $10 million. Thinking about these other ways that I may have put money aside And then if I sell and structure the company right, I can actually sell it for less and make more. What about a C to S conversion? One of the things that I'm encouraging people to do is we convert to a C Corp for a few years, build up a lot of earnings at the 21% level, and then after 5 years, convert back to an S Corporation. Well, why would you do that? Well, let's take a look at a C Corporation that makes $2 million a year. If I've got 30% tax on that, that's the 21% level plus our state, we're going to have about $600,000 in tax, about $1.4 million retained. And if I then kick that $1.4 million out at a 37% rate, it's another $518,000 in tax. I only get about $882,000. Well, what if I let it build up for a long time and then I convert it to an S Corp later? When you actually convert to the S Corp, we're going to have about a 42% blended rate between the 29% federal and our 13% state, and 840 tax. All right, on an annual basis, you're saving yourself $40,000. It's not huge, but it's something. But let's take a look at this. If my C Corp sold the assets, a net $7 million, and this is something that's maybe not a 1202 corporation, but just more than, we're at $10 million and we're not 1202 qualified. We're going to have a liquidating distribution tax as a dividend, and we're going to net about $4 million. But if I had converted that S Corp and waited the 5-year built-in gains period, I'm going to have a $5.8 million net instead of 4.4. Plus anything I built up after the conversion to an S Corp in my AAA. That's my accumulated adjustments account. That's cash you built up that you had already paid tax on. So if you convert to an S Corp, the retained earnings are taxed as a dividend at 37% unless you hold it for 5 years. We hold it 5 years, then the retained earnings, remember up in the very big example, that 1.4 in retained earnings, I'm going to get it out tax-free, just like AAA. Another thing I want you to talk or think about, and we talked a little bit about it with the captive insurance company, is a 978 trust. Entrepreneurs often don't like complicated estate planning because they have to give up control of the company, or they have to give up income, or they have to give up both. But under Section 678, you can have what they call a beneficiary protected trust. And it's protected from creditors, and it's exempt from estate tax. We do have a third-party trustee, but the great thing about it is that if the owners of the company are the beneficiaries of this trust, they are allowed to remove and replace assets. So they have control about what's in the trust, and they still control the companies on a daily basis. They can buy new assets using leverage. They can buy existing assets using leverage, often combined with an intentionally defective grantor trust. And one of the great things about the tax code is that the lifetime exemption for estate is an $11.5 million per person net worth now. It doubled. So for a married couple, they can give over $23 million away to their family without having an estate tax issue. So if we put property into a 978 trust, we can use some of that $23 million to move assets over there and still have everything being governed by the generation that gave it away. All that's left in the existing estate is a note for the sale of the business, their home, and I can use some of that $23 million to cover the note, their home, and maybe a few personal items. And the best thing is that nothing changes from an income tax or income perspective. The beneficiary generation, let's just call it Generation 2, who's running the business today, still gets all the income and they pay the income tax. But everything is protected from estate tax, and everything's protected from the creditors. So what are the advantages? I like looking at this type of scale. Simply, if I have a normal, simple living trust, then almost nothing changes. I'm still going to have 40% estate tax over $11 million per person, or $23 million for a married couple. Everything's still subject to my creditors. I do have full control, and I get all my income, and I pay the taxes. But if I look at the 678, I got no estate tax. I'm protected from creditors. I'm maximizing the use of my lifetime credits, and I still have full control and the current income and the current taxes. So by putting things in a 978 trust, I'm helping my family, regardless of whether my family takes over the business or not, because that value is going to be passing to them without estate taxes. So kind of to wrap up the presentation, I just want to kind of go through a little bit of a comparison. We'll have different types of exits. I can gift or sell to my heirs. I could sell to my employees. I could sell to a third party, which is what most people think of, but like I said, I want people to think outside the box. There's different types of sales. We could have a stock sale or an asset sale. And then what are the structures or the tax strategies? Well, some things we didn't really get into a lot are self-canceling installment notes or family limited partnerships. That's more estate planning. But the 678 trusts are even better than all of those types of estate plans. And it can go really well with the structure of your business. If I wanted to sell it to the employees, one of the ways I can do it from a tax protected status is an employee stock option plan or an ESOP. Now, we didn't talk a lot about ESOPs. There's only certain circumstances where they work, but it's something that can be explored. The consulting and defined benefit plan, I like that a lot because I can start building retirement for the second generation long before they retire and moving value out of the business to their retirement plan so that I can continue that on if they sell, or I can actually lower the sale price because they got some of the value out ahead of time. Another thing is we could do an installment sale. An installment sale defers your taxes over time. One of the things that I like to talk about some too is sometimes somebody, buyer doesn't want to buy your stock, they only want to buy your assets because they want the depreciation. Well, we want the better stock treatment for selling the stock. Well, there's a thing called the 338H10 election. We could structure the sale so it's like an asset sale for the third party, but it's like a stock sale for you. Cost segregation studies, we didn't talk about those, but that's another technique that can be used. We can actually get a lot of the assets above and beyond the Section 179 or bonus depreciation. We can get a lot of the assets in an asset sale to be segregated to shorter life terms so they're depreciated faster for your buyer. And then we did talk about captive insurance. So what's the summary? Saving taxes and good margin cycles. You got to do it because that's a way that you're going to put money away currently and also use those structures to help you in the future. Succession plan. I think you have to have one. You have to have an operator for your operating business because the only type of transition that will go without an operator is if you're selling to a strategic buyer, your competitor, who already has somebody who can manage the business. And that just limits the options way too much. You couldn't have a financial buyer. You can't have your employees. You can't have your heirs. You can't just retire unless you have somebody who's there to run the business. Readiness. I think that owners need to have mental readiness, be open to what the examples are, be open to what the opportunities are. And then we talked a little bit about some of the practical examples, how the tax code can help. And if anybody on this call is interested in going through the structure of where your company is today, we're happy to have an initial consultation where we can go through and we can map out a plan before you ever get charged anything. And that plan can really help you have an idea of what's the best structure to do. So with that, I'm open for any questions. We kept it underneath the hour for everybody. It's about 10:44. I really encourage everyone to go to SIOMA's Day in the Capitol in the first week of April. I believe it's the 2nd. I'll be giving a speech all on the new tax code and the changes that can help you, and it'll tie in right to what we were talking about today with succession planning. Well, I'm not seeing any questions on there, so thank you, ladies and gentlemen, and you can always feel free to call me at 949-852-1800 or my email, fwhitaker@cwlawyers.com, and I'll be happy to answer any questions offline.